Welcome everyone to Vested Interest. This is Shane, and in this video, this is our portfolio update. We're going to cover the $807 in new capital we added to the portfolio. We will cover any options we were in, any dividends received, any sales in the portfolio, shifts in income. We will do all of that. We do this every Sunday. For those of you who are new to the channel or maybe have not done so, if you could hit all the buttons down below, hit that thumbs up button if you find any value in the content. Make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever I put out any new content. I do this series weekly. We cover my portfolio update every Sunday. There is the thanks button down below for anyone who might want to help out the channel and buy me a cup of tea. Any funds that I do receive from that will be split between my portfolio and my two daughters' custodial accounts. That's what I plan on doing with those funds. And a very special to all the viewers and subscribers out there. The channel continues to grow because of people like you. Right around 1,400 subscribers right now. Let's get to 2,000. Let's get to 2,000, and I can only do that with your help. All right, now that we've got that out of the way, options, no options to speak of this week. We did throw out several options contracts, but no buyer on the other side. And that is the thing about options. You have two sides of the contract, the one you're writing, and then someone either has to be buying or selling on the other side. Dividends, on the other hand, another story. We had a very good week in dividends. On the 30th, we received funds from Schwab Strategic Dividend Growth ETF, ticker SCHD. $178.86 received. Now, we do have the DRIP set, which stands for Dividend Reinvestment Plan, and that just means anytime a company, in this case, this ETF, SCHD, pays out dividends, those dividends get reinvested right back into the same company. So with that $178.86, we picked up 6.76744 more shares of SCHD. And also on the 30th, Union Pacific, ticker UNP, out of the industrial sector, paid us $80.57. And again, those funds went right back in and picked up 0.34837 more shares. Passive income added by the new shares, $8.90. Total dividends received, $259.43. We could certainly turn the DRIP off and use those funds to pay bills, put in our savings, do whatever we needed to with those funds, put gas in the truck, pay a insurance bill or whatever we needed to. But again, we do have the DRIP set, so right now all of the funds from the dividends go right back into the portfolio. We were not done with dividends. On the 2nd, we received $207.92 total, and those funds came from HPQ, HP Inc. This is out of the information technology sector. They paid us $132.44, and those funds went right back in and picked up 5.18966 more shares of HPQ. Vanguard's index funds, this is another ETF. The total stock market here, total U.S. stock market, ticker VTI, paid us $75.48, and that went right back in and picked up 0.24829 more shares of VTI. The new shares picked up added an additional $6.90 in passive income over the next calendar year. And this is a very good example of what you might hear people say, the dividend snowball effect or compounded interest. This is a very good example of that. We had already spent some dollars and bought shares of HPQ. So we hold those funds, right? HPQ pays out dividends. Those dividends get reinvested. Those new dividends add new capital, and that is the snowball that keeps rolling. So if we were to add more funds to HPQ, obviously that snowball would roll a little bit faster, and the hill that snowball is rolling down is time. So the longer we allow this to compound, the larger this payout will grow. All right, now I do want to get into a little bit of activity. This one bridges what happened last week with our covered call with Cisco, if you remember. Those 200 shares were assigned, so they got called away, right? That just means that we ran two contracts on Cisco. It was a little bit above or a little bit below where we ran those contracts, so they get called away, right? Or it ran up above, that $68 strike price. So I think it was $69.32 or $69.36 at the end of the week, or $68.36, whatever it was. So because it was above our strike price, those got called away, so we received the $13,599.97 in capital, right, from selling those. And then what I did earlier in the week here, this past week, was I sold the additional 29 shares, and I think there's some fractions of a share there that we sold as well. at $69.36 and received another $2,011.53. So that's the $15,611.50 that you see here. And we did reinvest this with the funds from the assigned shares of Cisco and the sold shares of Cisco. Doesn't matter either way, we received funds for those. The only difference was for Cisco, we received a little bit more. The ones that were assigned, we received options premium as well as the sale, right? At 60, and we sold them at 68. But with those funds, the $15,611.50, we picked up 104 shares of Lennar Corp, ticker LENB. This is out of the consumer discretionary sector. We picked up those shares at $104.66. This is one that's in Warren Buffett's portfolio. He was picking up Lennar around $101 and some change. So we're a little bit higher than what he was, but my hope is that this actually drops back into the mid to high 90s, and I can add a little bit here and bring down my cost basis. So I may not be done building out this position, but I wanted to start a nice position here with some of the funds from that sale. Now, with the remaining funds, we basically just went in and bought SCHD. We bought two tranches here. I mean, we were around 5 minutes apart. What I really did was I tried to run covered calls on LENB and SCHD on Monday. No one bought them, so at the end of the day, I just went in and canceled that. I think it was like 358 or 356, whatever it was, right before the market closed. I canceled both of these cash secured puts that I was trying to run on Lennar and SCHD and just bought the shares outright. So that's why you're seeing 100 shares, and then I just went ahead and bought 104 shares of LENB. But this one here, we bought the 100 shares SCHD at $26.42, and actually earlier in the day we bought 78 shares. I didn't have quite enough to run two cash secured puts on SCHD, so I just bought those shares outright earlier in the day and then bought these at the end of the day. So we bought 178 shares, 100 shares at $26.42, 78 shares at $26.45, and that's why they're broken up like that. So I started out the day trying to run a cash secured put on LENB and SCHD. No one bid, and I just bought SCHD early in the morning when I tried to run those cash secured puts. No one bid on either one of them, and then at the end of the day there on Monday, I just canceled those cash secured puts and bought these outright so that I'd have them in the funds or have them in the portfolio. So with the assigned shares of Cisco, 200 shares there, and the sell of the 29 remaining shares, I think there's some fractions of a share, something like 0.29 or something like that. They came in on a little different, but it wasn't much capital that I received. So 229 shares roughly. We lost $375.56 in passive income. Now, with the new buys, right, the new additions here, LENB and SCHD, we added $393.26. So the difference was actually in our favor at $17.70 added to the portfolio by shifting out of Cisco, which was an information technology company, into LENB, which again is consumer discretionary, and SCHD, which is an existing position in the portfolio. And we really bought those, and I'm glad I bought them earlier in the week because I think by the end of the week it was in the mid $27 range. So perfect timing here on this one, just happened to work out in our favor. And again, we did, after losing some income from Cisco and gaining some from these new purchases here, the difference was in our favor at $17.70. All right, to the first new activity on June 30th. This is whenever I typically go into the portfolio on Monday. Every Monday I'm trying to run some options here, and then I go in and make my first buy. We added $381.11. With those funds, we added two more shares to our Occidental Petroleum position, ticker OXY, $42.19. Added one share of Owens Corning, ticker OC, at $137.46. I think this ended up in the mid 140s by the end of the week, so we may be done adding there. But if it drops back under 140, I'd like to continue to build this one out and get to 100 shares. I'm not quite there yet. Another one I'd like to continue to build out is Procter & Gamble, ticker PG, out of the consumer staples sector. And I like this one right around 161, 160, 159 or lower. So if it hovers in that range, I'm going to continue to add to this one. I'd like to get this one to 100 shares as well. I think I'm around 86 shares right now, 84, 85, 86 shares, somewhere in there. So I'd like to build this one out to 100 shares, but we added one more share of Procter & Gamble, ticker PG, at $159.27. This $381.11 in the new shares it picked up added $7.94 in passive income over the next calendar year. And we weren't quite done. We went back in on July 3rd, right before 4th of July, and added $426.33. And with those funds, we picked up one share of Comcast Corporation, ticker CMCSA. This is out of the communication sector. Picked up that one share at $36.20. This still remains under my cost basis, so I'd like to nibble here. Same thing with Occidental. I'd like to nibble on that one. Owens Corning and Procter & Gamble were actually both above my cost basis, but they're in my buy range, so I'm okay adding to those positions even though they're above my buy range. They keep me below where I want my cost basis to be still, so I do add to positions that are above my cost basis, so long as they're still in my buy range. Comcast is not one of those. They are below my cost per share currently, so I'm going to continue to add there, nibble a little bit, probably not a ton, but 1, 2, 3, 4 shares here and there. Now, the next two ETFs are part of my weekly buys, and I buy these regardless of the market. I'm going to continue to add to these positions, whether the market's up or whether the market's down, on a weekly basis, at least throughout this year and probably into next year, but we'll wait and see how the portfolio looks at the end of the year. Maybe we shift into another ETF, or maybe we continue to add to these, but right now, at least through 2025, I'm going to add to these two positions every single week. And that is SCHD, Schwab Strategic Dividend Growth ETF, added 3 more shares at $27.37. There you can see the difference, right? We were picking up those shares earlier in the week of SCHD in the 26 range. By the end of the week, they had jumped up to $27.37. And one share of Vanguard's Total Stock Market ETF, ticker VTI, that one share at $308.03. And that is the most I've paid. The market obviously has rebounded, so it seems like every single week now, I know I said it last week, maybe the week before, but it seems like every single week now, Vanguard VTI here is hitting a new all-time high, or a new high in my portfolio anyway, and that's the most I've paid at $308.03. Now, there's $426.33 new shares picked up with those funds, added an additional $8.09 in passive income over the next calendar year. Total invested $807.44. Total passive income added $50.34. That includes the sale of Cisco, new shares picked up there, and the dividends, and the new shares picked up from those dividends as well as the new capital added by me this week. All right, quick run through the sector weights here. Communication makes up 10.16% of the overall pie. There we are, consumer discretionary. We got a little bit of a sliver back in there at 2.82%. That's the new LenB shares, Lennar Corporation there, out of the consumer discretionary sector that we picked up this week. Consumer staples at 8.49%. Energy makes up 9.7% of the overall pie. Financials at 2.59%. Healthcare is now the largest position in the portfolio at 18.31%. Industrials makes up 6.72%. Technology in second place at 16.39%. Materials makes up 2.39%. Utilities at 3.87%. And if NextEra Energy drops back below 70, it dropped in 67 range there for a little bit briefly, but now it's back up above, I think, 72, 73 per share. I'd like it under 70, but if it does drop again in the 60s, I probably will add to that position. REITs and real estate at 5.78. I'm really waiting for VICI to drop a little bit. I'd like it back in the 31 or below 30 really, but if it dropped into the 31 range, I might add some there. And ETFs is starting to become one of the larger positions in the portfolio, currently in third place. Eventually it will overtake the entire portfolio just by the nature of adding to it every single week. And it makes up 12.8% of the overall pie currently. Now, over here to the right, you can see those same percentages breakdown that matches the pie here, as well as the dollar amount allocated to each one of those sectors as well. All right, here it is. I show this every week. This is my overall portfolio breakdown here. I want you to see a real portfolio built out over time so you can understand the ups and downs of owning not only ETFs, but also individual positions. Hopefully it gives some of you out there who are on the fence or maybe haven't started your own investing journey the confidence that you can do it too. You don't have to be a financial guru. I am not a financial guru. I did not go to college for finances. I do not have a background in this or a rich uncle who's showing me the ropes, so to speak. I'm learning as I go, and hopefully you can learn from the mistakes I make and don't make the same mistakes. And again, hopefully it gives some of you the confidence that you can do it too. And hopefully it also gives some of you that maybe after you first started your portfolio and you see a position drop by 8%, 10%, 9%, 20% even, whoa, I shouldn't sell it. Because if you've been watching for a while, I mean, Valet was down almost 30% at one point. We kept buying it. We brought down our cost basis. Now it's come back, and now we're only down 9%. CVS, for example, I was down 30% at one point, right? Same thing. We kept buying it. We brought down our cost basis, and now we're back up 4.48%. Which another one? Another good one is Lam Research here, ticker LRCX right here. Right? At one point, we were buying this down at $72.92. It even dropped below that and dropped into the 66, 64 range. We kept buying it. I think my cost basis at one point was right around $78, $79. You can see right now it's $72.92. And then maybe that's a good video I should do. I should go back in time and look whenever I first bought Lam Research, see what my cost basis was, and then go over weekly how I kept buying as it was dropping. And then now, as you can see, we kept buying, we kept adding to our position, even though it was below our cost basis at times. And now we're up 35.5%. So just because you see red, right, you see a position drop into the red or drop by 20% or drop by 40% even, does not necessarily mean you should run out and sell the position. If there's nothing wrong fundamentally with the company, and it's just a drop temporarily, maybe on negative news, maybe they had a negative earnings report, maybe they dropped their future outlook, maybe a war broke out, maybe there was a storm for energy companies, maybe there was a storm off the coast that impacted our refineries got shut down for a day or something like that. Energy gets impacted by just storms out in the Gulf Coast, I feel like, because they do some drilling out there. So there's all sorts of reasons a company, I mean, maybe there is indeed some fundamentally wrong with the company, but there are all sorts of reasons outside fundamentals of a company that companies go up and down. And it's your job as an investor to find the times when those companies get disconnected from the fundamentals of the company. Fundamentals are still good, price is going down. Those are the times I want to be buying. I want to find those good companies with great fundamentals and wait for them to have big pullbacks, whether it's temporarily or for a prolonged period of time, and be buying them whenever they are relatively cheap and waiting for the rebound, just like we did with Lam Research, just like we're continuing to do with Comcast, right? We're still down 8.33%. As you saw, I added to this position this week. So just because I see red does not necessarily mean I'm going to sell. Doesn't necessarily mean it's a buy either. I go back in, I look at the fundamentals of Comcast, and I say, yep, still meets the criteria that I'm looking for. And if it does, then I should be buying when it's 8% below my cost basis. If I thought it was a good price at $39.26, I should think it's a better price at $35.99. The market, the stock market, seems to be the only market that people walk into and they see a sale and they want to run away, right? You don't walk into Walmart or Myers or Kmart or Kroger and see a sale on a product you were going to buy and say, oh, I'm not going to buy it now because it's cheaper. No, you probably buy it and then buy something else because you have funds left. Or maybe you buy two of them, whatever it was that you were going to buy, because they're cheaper now, right? So just because you see red does not necessarily mean the company's bad, does not necessarily mean it's a reason to sell. It might be a reason to look more into the fundamentals, but if the fundamentals of the company are strong, you had set a good buy price, and it's below that buy price, you should continue to add. Hopefully that came across correctly, and it doesn't come off as preachy. So I'll get off my soapbox there for a little bit, and we'll run through the rest of this here. This column here shows all the different positions in the portfolio, total shares, and all of these numbers are as of the close of business on Friday. Current price of each position here, market value here, average cost per share. That's my average cost per share, and it does include reinvested dividends in this column. My purchase price, what I have into each position, and that again does include reinvested dividends. Whether I'm up or down, you're going to see total return here, percent return here, what sector each position falls in, whether they're a quarterly, monthly, semi-annual payer. You'll also notice here that I have the the companies that have raised their dividends already this year, they're highlighted in yellow. That's what the highlighted in yellow means. Current yield in this column, my yield on cost here, portfolio weighting. So what we saw with the previous slide was each sector weighting. This is each individual positions weighting. And I do have a rule in the portfolio. I do not want any one position to be more than 10%. I do not want any one sector to be more than 20 to 25% of the portfolio. I don't really have anything close. Lam Research is the closest at 6.9%, and that is only because it's up, 35.5% now. Second place is what? VTI? Yeah. Looks like VTI is second place at 6.64%. And SCHD there, 6.16. Is that third? No. Second place would be, third place would be Google, and then SCHD. So VTI and SCHD are in the top 4 or 5. But it looks like Lam Research and Google are the top 2. Both of them happen to be in the tech sector. All right. Portfolio weighting, we just went over. Estimated annual income here. Payout months here, where they typically pay out. Obviously, VTI, for example, just paid out in July. It typically pays out in June, but every now and again it will slide into a different month, and sometimes that happens, especially if you have their payout dates towards the end of the month or towards the beginning of the month. They might creep into the next month or the previous month, depending on when their payout dates fall. But typically, this is when the company's payout months hit. Dividend growth year over year, where a company sits at 15% of a 52-week low. Let's talk about this for a minute. Procter & Gamble seems to be a good example right now. Yeah, 86 shares. I'm trying to get this to 100 shares. So I added some this week, added some last week. I like it around this $160 mark or lower. As you can see, that's above my cost basis of $155.05 here. But my buy price, I want it at 15% of a 52-week low is $180.06. So my buy price is actually a little bit lower than this, but I want my average share cost to be below this. So even though the current buy price at 160 is above my average cost per share, it's well below 15% of a 52-week low. So I will continue to add this. I like this right around 161, 160 or lower. I'd love it to drop back into the 150s or 140s even, so I can build this out cheaper. But I can buy it all the way up to 180.06. So hopefully that makes sense. All right, total shares, 7,571.050 shares, $389,372.93 is what the portfolio is currently week. Getting getting very close to 400,000. I think we will break through 400,000 by the end of the year, especially if the market continues to climb like it is. Obviously, we're adding funds every week, but I am going to say we will get over 400,000 in the portfolio here, unless there's a huge pullback overall. We should make it by the end of the year. We'll see. What I have into the portfolio, $348,888.54. Again, this does include reinvested dividends. So it's not just all money, new capital out of my pocket. It's reinvested dividends over the last, 4, almost 5 years also. Total return here, I am up $40,484.40. I do not pay attention to this. I mean, it's nice to see, but it's not something I completely focus on. I am up 11.6%. Again, not something I really focus on because I can't get this unless I sell out of all the positions, right? I can't lock in this gain unless I sell. My goal or my objective in the portfolio is not to sell positions. I know I did sell Cisco there last week, but that's because I felt like LenB was a better opportunity right now. As you can see, 105.62 is where it closed out the week, so we're up slightly there, but I felt like this was a better opportunity than Cisco right now. I also wanted to add something back into the consumer discretionary space. But again, I don't want to sell out of all the positions, and then I'd get this $40,484.40, but then I don't have a portfolio anymore, and it's not producing this $13,353.24 in passive income. So I don't really focus on return. I mean, it's nice to see, again, I want to be up. Everyone wants to see green in their portfolio, but it's not a huge focus of mine. You heard me say that when I was down 8, 9, 10% as well. So it's just not really a focus. Again, nice to see, but not my main focus for the portfolio. Current yield, 3.429% of the portfolio. Or I'm sorry, 3.429% is the current yield of the portfolio. My yield on cost is 3.827%. And this is what I focus on. That's why it's over here circled in red. All the dividend income paid out by the positions in the portfolio. And this continues to grow week over week, month over month, quarter over quarter, year over year as I add new capital, as the positions in the portfolio pay out dividends. As they raise those dividends over time, this grows, and it currently sits at $13,353.24. And we should be over 13,400, I would say maybe by the end of the month. We should be by the end of July. We should be into the 13,400 and some change range, I would say, and I really would like this to be above 14,000 by the end of the year. So we'll have to wait and see if we get there. Obviously getting pretty close, but we've been adding around $30 to $50 a week, so you can do the math. We should be able to get above 14,000 by the end of the year here. It's going to be close. Dividend growth year over year at 5.72%. This does get adjusted as the companies adjust their dividend payouts and their dividend growth rates. All right, well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey of financial freedom. Join the vested interest community and drop a comment down below. Let me know what you think of the video. Do we have any positions that are the same? Have you sold out of any positions and reallocated any funds elsewhere? What are you buying if you are buying? Or maybe you backed off buying. Maybe you're building some cash positions. I hear a lot more people talk about building cash positions right now as the market hits all-time new highs, and I have seen some people starting to take profits. So love to hear from you if maybe you're trimming some positions or selling out of some positions that maybe are overweighted or have run up in your portfolio and you're taking some profits. Let me know in the comment section down below. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money, so never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor. For those of you who made it to the end of the video, thanks for watching to the end. Watch time is one of the metrics that the YouTube algorithm looks at, so I really do appreciate it. Don't forget to hit the subscribe button on your way out if you haven't done so. Hit the like button, share with anyone you think that might find value in the content, and drop a comment on your way out. Let me know that you stayed to the end of the video. Thank you.